Welcome to our overview of the 2011-2012 tax sale, talking about gift, estate, and generation skipping. Well, what's a tax sale? Well, Congress just passed and the President on December 17th of 2010 just signed the Tax Relief, Unemployment Insurance, Reauthorization, and Job Creation Act of 2010. Quite a mouthful. I'm just going to refer to it as the 2010 Act. The 2010 Act gives certain people the possibility to pay less transfer taxes now than later. This possibility is a limited time opportunity because the law is set to expire at the end of 2012. Who are those people who can take advantage of the sale? People who in 2013 going forward might potentially have taxable estates. People with excess assets to give, i.e. assets that you don't need to be spending right now. Go to some tax history. The estate taxes traditionally had a fixed exemption amount per person. It was $600,000 for a lot of years, then $675,000, then $1 million. In 2009, it was $3.5 million exemption per person. In 2010, there was no estate tax, but we traditionally had this estate tax exemption amount. The gift taxes similarly had an exemption amount. For many years, it was the same as the estate tax exemption amount, and then back in 2001, it was decoupled. The gift tax exemption amount was $1 million, and the estate tax exemption amount ranged up to the $3.5 million threshold. We also have a third tax to consider, the generation skipping tax. The generation skipping tax is an amount of money that you are allowed to give to grandchildren or a future generation without incurring a tax at the child's generation and also at the parent's generation. And this amount has always been equal to the estate tax exemption amount, even as it. So which tax applies if you're making a gift? Well, all three of the transfer taxes might possibly apply. The gift tax exemption is going to apply to any gifts made during your lifetime in excess of your annual exclusion amount. Everybody can give away, this year it's $13,000 per year to anybody that they like, but any gifts over that reduce that lifetime gift tax exemption amount. Your estate tax exemption amount is reduced by lifetime gifts. So if you make a taxable gift during your lifetime, whatever estate tax exemption amount is available at your death is going to be reduced. And then you have to look at the generation skipping tax because depending on who you make the gift to, for example, if you make it to grandchildren, the generation skipping tax exemption can either be applied to a lifetime gift or to transfers that you're going to. Well, why are we saying that the taxes are on sale this year? Well, let's take a look at this chart. We're going to go back to 2009, the last year that these estate taxes were in effect. In 2009, there was a $3.5 million per person exemption from estate taxes and a maximum tax rate of 55%. Let's contrast this to what happens to somebody who passes away in 2011 or 2012. In that situation, we're looking at a $5 million exemption per person with a maximum tax rate that's come down to 35%. That sale on those taxes, however, ends in 2013 when the estate tax exemption amount is scheduled to return to $1 million and that estate tax rate is going to increase to 55%. Let's look at the gift tax. The gift tax in 2009 and in 2010 there was a $1 million exemption amount and a maximum 55% rate. 2011 and 2012, that exemption amount has been increased to $5 million per person, and the tax rate reduced to 35%. In 2013, the tax scheme reverts to the way it was in 2009, with a $1 million exemption per person and a maximum 55% tax rate. Let's look at the generation skipping tax. This mirrors the estate tax. It's a $3.5 million exemption and a maximum 55% rate, being increased in 2011 and 2012 only to a $5 million exemption with a maximum 35% rate, and reducing again in 2013 to a $1 million exemption with a maximum. So what happens with the estate tax in 2011 and 2012? It's on sale. That's terrific. We have this increase to $5 million exemption amount. We have a decreased tax rate. We have this new concept found in the tax code that your estate tax exemption amount is portable. Let's say that we have a married couple and the husband passes away, and for whatever reason, he didn't use $4 million of his $5 million exemption amount. Well, if his wife then passes away, She's then allowed to use not only her $5 million exemption amount, but add to that his $4 million exemption amount. While all of this is great, unfortunately, it's not incredibly useful. First, in order for it to affect you at all, you need to die in either 2011 or 2012, and that's not the kind of planning that we get involved in here. Second, there's some confusion over how the portability is going to work if one spouse does actually pass away in 2011 or 2012, and the other spouse passes away in 2013 going forward. Does that portability? Let's look at what is useful, the gift tax changes. For 2 years only, your exemption from gift taxes has been increased by 5 times over. It's more exemption that's been available for planning purposes in anybody's memory. In addition to that, we have a decreased tax rate. Also, in making gifts, we have some confidence in the outcome. This isn't like the estate tax where somebody has to pass away within a certain period of time. As long as gifts are made in 2011 and 2012, we're sure that those are going to be sheltered from gift tax at the time that they are actually. And let's flip over to the generation skipping tax, looking at these opportunities in 2011-2012. Again, we have this increased exemption amount where it now matches the gift tax exemption amount. This is very important because one of the planning opportunities for people are to make gifts that are also exempt from generation skipping tax to create wealth that is going to go from one generation to another without transfer taxes. We have a decreased tax rate. The generation skipping tax rate has always been at 55% and a flat 55%. And the fact that we have this large gift tax exemption amount together with this large GST tax exemption amount creates leverage. There's an ability to make gifts that can be sheltered from tax at each successive generation. A person could give $5 million in trust for their children. That could grow during the child's lifetime. When the child passes away, it's now going to go tax-free to their children. If they don't need it, it'll grow during their lifetimes. When they now pass away, it's going to go tax-free to their children, and so on, which avoids the government having a bite at the apple, whether it's at 35% or 55% upon the passing of each. So what are the opportunities that are available now? Well, the opportunity is that you can gift excess assets. We say excess assets, assets that you don't need right now to support your lifestyle. There's a lot of opportunity for somebody who maybe has a family business that they're not running anymore, or even if they are running the family business, to maybe transfer some non-managing, non-controlling shares to the next generation to take advantages of these sales. Same concept with real estate, to transfer equity in real estate, but not necessarily control of real estate to the next generation. To transfer portfolio assets if you aren't going to need the income or assets going forward to support your lifestyle. The other opportunity then is to couple this to remove the asset from further tax by not just giving it outright to the child, but giving it to the child in this generation skipping trust where the child and their issue are potentially beneficiaries, where again it's going to pass to those further issues in trust with no transfer taxes. The key thing with this opportunity though, it's a limited time offer. You have to act before December 31st of 2000. Well, what are the considerations that we have to have? First of all, you really need to be making transfers of true excess assets. These need to be completed gifts, which means that they can affect your lifestyle and they can affect the control that you have over your remaining assets. Secondly, in making large gifts, if we come back to a place where we have a very low estate tax exemption amount of $1 million, the amount of estate taxes that are actually being paid may increase at death such that you may not be able to make distributions of death of the same amount of assets. There may be more taxes than you anticipated being paid. And also, you always have to consider how are we transferring assets. It's no good to take assets and transfer them just to avoid taxes, but to give them to somebody where there's a creditor risk and now somebody else has your money. And if you have any questions, we encourage you to visit our website at www.findsuch.com or our blog on this subject at njelderlawestateplan.com. You can reach any of the attorneys that practice in our tax department here, and we have to put in our warning that the materials on this site are only for informational purposes and do not constitute legal advice. This information is not intended to establish an attorney-client relationship unless and until an agreement retaining our services is signed. Having said that, we're always delighted to answer questions to be able to inform people how they can take advantage of opportunities that now exist in the tax code. Thank you for listening.